Let's do some problems together to practice some of the computations that you need to do in order to perform variance analysis. These problems involve a company called Managerial that makes high-speed internet connectors. Before the period started, the firm prepared a master budget that included budgeted variable costs of $145 per unit, budgeted fixed costs of $7,500 a month, and was based on the production and sale of 100 units in November. Once the period's over, this master budget will become the static budget. The firm actually produced and sold 84 units and had actual total costs of $21,000. So, my first question to you is, what is Medinets' total flexible budget cost for the 84 connectors that it made this month? Pause your slideshow so that you can figure this out, and then we'll discuss the answers. The formula for the total flexible budget cost would be the budgeted variable costs at the actual quantity produced plus the budgeted fixed costs, which are assumed to be fixed within the relevant range. We know that the variable cost per unit was budgeted at $145 per unit, and the firm actually made 84 units. We can multiply the budgeted variable cost per unit times the actual units made to find the total flexible budget for the variable costs, and add the budgeted fixed costs to get the total amount that the firm would expect in its flexible budget for the actual number of units produced. Now, let's think about Medinets' sales volume variance on total costs. Pause your slideshow and try to answer that question. The sales volume variance is the difference between the budgeted costs at the actual level of activity and the budgeted costs at the expected or budgeted level of activity. The variable cost for the actual level of activity is $145 per unit times the 84 units that were actually made. The budgeted cost at the budgeted level of activity is the same $145 per unit times the 100 units that were expected to be made. In this particular problem, there's actually no need to consider the fixed costs because at the budgeted level, the fixed costs would be the same in a flexible budget or in a static budget. So we could add the fixed costs to both amounts, but then they would just cancel each other out. The sales volume variance turns out to be $2,320 favorable. So why is this answer favorable? Remember, when it comes to costs, favorable means lower than expected. So the actual flexible budget costs were lower than the expected static budget costs. That's why this answer is favorable. But is this good news or bad news? Well, it certainly is less expensive for the firm to make fewer units, but if the firm makes fewer units, chances are they're going to generate less sales revenue because they have fewer units to sell. So the cost is lower, but it's not necessarily a good thing. What is Medinets' flexible budget variance on total costs? Take a minute to try to answer this question, and then we'll look at the solution. The flexible budget variance is the difference between the actual costs and the flexible budget at the actual level. We know the actual costs because they were given. The flexible budget costs include the variable cost per unit times the 84 units that were actually made, plus the fixed cost. We can add those together and subtract the flexible budget amount from the actual costs. When we do, we find that the actual costs were greater than the flexible budget would have predicted by $1,320, which we mark unfavorable. But why is this answer unfavorable? We can see that the actual costs are greater than the flexible budget would predict. But is that good news or bad news? It depends. It may simply be that costs have gone up. In that case, it's a signal to the firm to change some of their budget estimates for the coming period. On the other hand, it may be that the firm didn't shop very well for some of their flexible budget items, so they spent more unnecessarily. Another possibility is that the firm actually intentionally spent more. For example, if the firm has had problems in the past with defective direct materials, then they might choose to pay more than they had originally budgeted to get the quality that they need. Now, let's take a look at Medinets' use of direct labor. How could the firm establish standards for its use of direct labor? Take a minute to think about it, and then we'll look at the solutions. Time and motion studies are used to set labor standards by observing how long it takes for workers to do various tasks. Continuous improvement is a strategy to try to motivate employees to do a little better this time than they did last time. And benchmarking means setting the standard based on some expectation and then assessing whether people achieve that standard. Therefore, all of these are valid ways to set direct labor standards. Let's look at some information about Medinets' use and expectations for labor. The firm had budgeted that it takes 3 labor hours to make each unit, and their standard for wages is $17 per labor hour. In November, their employees actually worked 189 labor hours to complete their 84 units, and all 84 units were sold. Medinet actually paid its workers $17.80 per labor hour. So, my first question to you is, what is Medinet's direct labor price variance for November? Take a minute to answer this question, and then we'll look at the solutions. The formula for a direct labor price variance is the difference in the price between the actual price and the budgeted price at the actual quantity used. We were given the standard price, $17 per labor hour, and the actual price, $17.80 per labor hour. And we know the actual quantity of direct labor that was used. So let's put these into our formula. This formula says that the direct labor price variance is the dollar difference between paying our workers $17.80 versus paying them $17 that we expected to pay, times the 189 labor hours that the firm used during the period. Altogether, that tells us that that little 80-cent per labor hour difference cost the firm $151.20 unfavorable. In other words, the firm spent more on direct labor than they expected because they paid their workers a little bit more per hour than expected. And we can see that from the given information. The standard price was lower than the actual wage rate that the firm paid. But is this good news or bad news? And the answer is, it depends. If the firm gave their employees a wage increase, then what we learn from this analysis is stop budgeting $17 an hour, because that's not what our workers get now. They get $17.80. Or it may be that the plant manager chose a different employee to do the work. In that case, we would have to look at the direct labor efficiency variance to see whether that was a good strategy, because it did cost the firm more money. So, what is Medinet's direct labor efficiency variance for November? Take a minute to try to solve this problem. The formula for a direct labor efficiency variance is the standard price times the difference between the actual quantity of labor used and the expected quantity. We know the standard price, $17 per labor hour, and we know the actual quantity of labor used, 189 labor hours. But what is the standard quantity? That amount wasn't given, but we have enough information to figure it out. The firm expects to use 3 direct labor hours to make each unit, and we know that the firm actually made 84 units. So that means that the standard quantity for the actual number of units made is 252 labor hours. Now we can put this information into our formula. So what we're trying to find is the dollar difference that it makes that we actually used fewer labor hours than we would have expected, given the fact that the standard wage rate is $17 per hour. In other words, ignoring any price variance for labor. It turns out that this reduction in the number of labor hours actually used compared to the number of labor hours that were expected saved the firm $1,071 because the firm used fewer labor hours than expected for the units that it made. And we can see that in the information by comparing the actual quantity of labor to the standard quantity for the 84 units that the firm made. But is this good news or bad news? Again, it depends. For example, it may be that the workers were so happy that they got an 80-cent per hour wage increase that they worked much more efficiently. Or it could be that the manager's choice to use a more experienced worker who already got a higher wage rate resulted in much more efficient production. But those aren't the only possibilities. It may be that the workers did the work faster, but made more mistakes along the way. So that would have a bad effect on the product's quality. The point about variance analysis is that you still need to investigate why a variance occurred and then determine what that means for the firm going forward. Now, let's take a look at Medinets overhead variances. We're told that the firm allocates overhead based on machine hours and an expectation that it takes 11 machine hours to make each internet connector. Before the period started, the firm had a master budget that was based on 100 units made and 11 machine hours per unit, which gives us 1,100 machine hours during the month. And it also estimated its expected total variable manufacturing costs at that level of activity and its expected fixed manufacturing overhead costs. Once the period's over, that master budget becomes the static budget. During December, the firm actually used 1,000 machine hours to make 110 units, and were told how much they actually spent for variable manufacturing overhead and fixed manufacturing overhead. So, my first question to you is, what is Medinets' predetermined overhead rate for variable manufacturing overhead during December? Pause your slideshow so you have a chance to try to answer this question. Remember that the formula for a predetermined overhead rate for variable manufacturing overhead would be the total budgeted variable manufacturing overhead divided by the budgeted amount of the allocation base, in this case, machine hours. So, based on the 100 units that the firm expected to make, we know the budgeted variable manufacturing overhead because it was given, but we weren't told the budgeted number of machine hours. Luckily, we have enough information to figure it out. We can multiply the 100 units that the firm expected to make before the period started times 11 machine hours per unit, and that tells us that the budgeted allocation base would be 1,100 machine hours. Now, all we have to do is put that information into our formula, and it tells us that the predetermined overhead rate for variable manufacturing overhead is $5 per machine hour. And that becomes the standard price for variable manufacturing overhead. So, what is Medinets' variable manufacturing overhead spending variance? Take a minute to figure this out before you check the answers. The formula for the variable manufacturing overhead spending variance is the difference between the actual cost for variable manufacturing overhead and the actual quantity of the allocation base times the standard price. We were told the actual cost for variable manufacturing overhead, and we were also told the actual quantity of the allocation base, 1,000 machine hours. We just figured out the standard price. That's the predetermined overhead rate of $5 per machine hour. So we can put that into the formula, and it tells us that the actual cost for variable manufacturing overhead was $600 greater than what it would have been if we had spent $5 per machine hour for the 1,000 machine hours that we actually used. In other words, the firm spent more on variable manufacturing overhead than expected, spent more than the $5 per machine hour that the firm had budgeted. Is this good news or bad news? It's mostly just news. There's usually not much that the firm can do about changes in the cost of variable manufacturing overhead items, except to budget a little bit more in this case going forward. What about Medinets' variable manufacturing overhead efficiency variance? Pause the slideshow and take a minute to try to figure this out. The formula for the variable manufacturing overhead efficiency variance is the difference in quantity between the amount of the allocation base that we actually used and the amount that we would have expected to use for the actual level of activity times the standard price. We were told that the firm actually used 1,000 machine hours, and we've already figured out that the standard price, that is the predetermined overhead rate for variable overhead, is $5 per machine hour. But what about the standard quantity? We'll have to figure that out. We know that the firm budgets 11 machine hours per unit, and during this period they made 110 units. That means that they would have expected to use 1,210 machine hours to make these units. Now we're ready to put this information into our formula. So, the difference in quantity between what the firm actually used and what the firm would have expected to use for 110 connectors is 210 machine hours. The firm used fewer hours than expected. If we multiply that by the standard price, $5 of variable manufacturing overhead per machine hour, we get a favorable variable manufacturing overhead efficiency variance of $1,050. In other words, this variance occurred because the firm used fewer machine hours than expected to make the number of units that they actually made during the period. And we can see that when we look at the given information. But is this good news or bad news? Well, it depends. If workers found a more efficient way to manufacture these units, then we're delighted that they can do that using fewer machine hours. But if they did the work faster by leaving out critical steps that would have a negative effect on the quality of these internet connectors, then we'd like to find out about it and put a stop to it. What if we were interested in finding the fixed manufacturing overhead spending variance? The formula is the difference between the actual cost for fixed manufacturing overhead and the budgeted cost. In this particular case, both of these amounts were given. So all we have to do is find the difference, which is $50 unfavorable. That occurred because our actual fixed manufacturing overhead costs were higher than we budgeted. This isn't really good news or bad news. It simply tells us that it doesn't make sense to continue budgeting $8,250 for fixed overhead when in fact it's now costing us $8,300 for fixed overhead. What about the predetermined overhead rate for fixed manufacturing overhead? The formula is the budgeted overhead divided by the budgeted amount of the allocation base. We were told that the firm expected to make 100 units during the period, and we were told that the firm had budgeted $8,250 for fixed overhead. But what about the budgeted machine hours, the allocation base? To figure that out, we multiply the 100 units that the firm expected it would make times the 11 machine hours that it expected to use to make each unit. That means that the firm must have expected to use 1,100 machine hours. So the predetermined overhead rate is the budgeted amount of fixed overhead divided by the budgeted machine hours. And that tells us that the predetermined overhead rate for fixed overhead is $7.50 per machine hour. And that becomes our standard price for fixed manufacturing overhead. The formula for the fixed manufacturing overhead volume variance is the difference between the budgeted costs and the amount allocated, which is the standard quantity of the allocation base that the firm would expect to use at the actual level of activity times the standard price. We know the budgeted cost because that was given, and we just figured out the standard price. That's the predetermined overhead rate, $7.50 per machine hour. But what about the standard quantity at the actual level of activity? That amount represents how many machine hours the firm would expect to use at the actual level of activity. And we can figure that out because we know that the firm expects that it will use 11 machine hours per unit, and the actual level of activity was 110 units. So that means that the firm would expect to use 1,210 machine hours. Now we can put this information into our formula. And we find that the amount that was allocated out is greater than the budgeted cost for fixed overhead by $825. And we mark that favorable. Remember that the predetermined overhead rate is based on an expectation that the firm would make 100 units during the period. If the firm did, then the fixed manufacturing overhead volume variance would be exactly 0. But that's not what happened. The firm actually made 110 units. Therefore, the firm's fixed manufacturing overhead was over-allocated. That is, the firm's managerial accounting system continued to allocate overhead to the additional units made. Of course, that overhead didn't really exist, and we can adjust for it at the end of the period by reducing cost of goods sold. In this case, the firm used its productive capacity more efficiently than expected, so that each unit that was made ended up carrying a smaller share of the firm's fixed manufacturing overhead than the budgeted $7.50 per unit. The moral of the story is that decisions are only as good as the information and the skill used to make them. The numbers that we've seen in variance analysis tell a story, and smart managers want to understand that story so that they can make better strategic decisions going forward. This is the end of chapter 23.